Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to summarize the big tech stocks earnings report which came out this week and compare these reports for some of the largest publicly traded tech companies in the world. I mean Apple, Microsoft, Google, Amazon, and Meta. I divided these earnings reports into 5 categories of great, good, okay, bad, and disaster, depending on the numbers and future forecasts reported in these earnings of each company. I'm invested in 3 of these mega cap tech stocks right now: Google, Meta, and Amazon, and that's why I read the earnings report of these companies carefully and follow their news. I will start with Apple as the largest company on the planet with a market cap of over $2 trillion, and I think their earnings report was bad. The numbers they report were not good by any means. Their reported numbers were lower than expectations in both top-line revenue and bottom-line earnings. The only reason I don't consider this a disaster is that the market already was expecting Apple to miss on estimates and it was ready for weak numbers. Apple reported a total revenue decline of almost 5.5% year over year. Their EPS decreased 10.9% year over year. Net sales declined in their devices segments, while slightly increased across their services. Their operating costs increased year over year, and most segments of their business performed poorly compared to the last year, particularly MacBook and iPhone sales, which were down 28 and 8% respectively. But iPad and services did relatively good in this quarter. Market already expected a decline in Apple revenue and sales this quarter, so this was not a shock to investors. They still have an amazing balance sheet, amazing margins, and a sticky business model which continue to generate profits for the company. So overall, I think the numbers in this report were bad, but they were not a disaster. And therefore, I think it's fair to say that this was a bad earnings report for Apple. The next earnings report that I cover is related to Microsoft. And I think their earnings report was okay. The numbers they report were not amazing by any means, but they were mostly in line with the expectations. Microsoft was able to beat its earnings estimates on bottom line, while slightly missed on top line revenue estimates. Microsoft total revenue was slightly up this quarter year over year, while their earning per share is down year over year. Of course, the biggest story of Microsoft in this quarter was once again their cloud services and Azure, which is still growing fast. If we look at each segment of their business, Azure and cloud services, as well as LinkedIn, are doing very well. While their hardware segment, I mean mainly Surface devices, their Windows-related services, and also their Xbox division are not doing well and are in significant decline path year over year. Xbox negative growth is weird to me as Sony recently reported a strong earnings related to their PS5 sales, so I'm not sure why Xbox division of Microsoft is not growing right now. Overall, not amazing numbers in this report, but the growth in cloud services and Azure helped Microsoft to somehow meet the estimates despite awful results in hardware, Windows, and Xbox segments. I think overall, this was an okay report for Microsoft shareholders, but nothing really amazing here to note. The next earnings report that I cover is related to Google, and I think their earnings report was also bad. The numbers they report were not great by any means. They missed on both bottom line earnings and top line revenue estimates. If we look at each segment of their business, Google ads in both search and YouTube declined year over year, which is terrible. Compared to the last year, they still increased the number of their employees by more than 30,000 people, which is crazy. Even if we take the recent layoffs into account, they still managed to somehow increase the headcount of the company by a huge margin, and at the same time showed a decline in the revenue from their core businesses, which is really bad. The only positive thing in this report, which caused, I don't basically categorize this as a disaster earnings, was the rapid growth in their cloud business, which is going to be a cash flow positive segment in the next 2 years, in my opinion. I still like Google. I think they have a strong moat, a strong balance sheet, and super profitable business model. But overall, this report was basically was a bad earnings report. For the next earnings report, I will look into Amazon. And I think their earnings report was okay. They beat the top line revenue estimates but missed on bottom line earnings. But the worst part of their report was actually in the guidance for a continued path of low profitability to zero profitability, which caused the stock to crash the day after this earnings report. If we look into the various segments of their business, their operation in North America and especially internationally is not profitable at all at the moment. They actually lost more money in 2022 versus 2021 with their e-commerce and other businesses. AWS is the only thing that bailing out Amazon at the moment, and it is still growing fast, albeit the growth rate is also declining in AWS. We all know that Amazon reinvests pretty much everything back into their company, and they are investing a lot of money to basically gain market share. So I don't think looking at EPS or earnings is the best indicator for Amazon. In terms of the growth in each segment, third-party sellers, subscription services, advertising services, and of course the cloud services, AWS, all growing fast, which is a positive for Amazon. Amazon doesn't care about profitability at the moment, and they just want to grow and control more market share, and I believe they are successful in doing so. Overall, nothing amazing in this report, but I think the numbers and trend is in line with the expectations, and that's why I think this was an okay report for Amazon. The last earnings report I covered today is Meta earnings, and I think it was a good report overall. They beat on top line revenue estimates and missed on bottom line earnings estimates. They reported a 5% growth in family of apps daily active users and 4% growth in their monthly active users. And look at these numbers. Almost 3 billion people use at least one of their apps. I mean Facebook, Instagram, WhatsApp, or Oculus daily, which is crazy. I don't know how they still basically managed to grow this number. It means almost half of the world population is already using one of their apps every single day. They also announced $40 billion share buybacks program, which is significant. I guess while all of these are impressive, the most important reason for surge in Meta share price after this earnings report was not any of these metrics. It was Mark Zuckerberg's statements about restructuring, cost cuts, and being a more efficient company. They were supposed to spend between $94 to $100 billion in 2023, and now they revised these numbers to spend only $89 to $95 billion. And that's a huge difference in their profitability and free cash flow for the next year. Market was angry with Zuckerberg spending 2 months ago, and now it is happy with Mark Zuckerberg's decision to cut the costs and focus on efficiency. I think overall this was a good earnings report. As you can see, none of these big tech companies reported amazing numbers this quarter, but that was pretty much expected by the market, and that's why we don't see a market crash based on these numbers yet. There you are, guys. I hope you enjoyed the video. This was a very quick video, summary video. And if you enjoyed the video and my coverage of earnings report of various stocks, consider subscribing to the channel to see similar videos. Thank you for watching, and I hope to see you guys in the next video. Farewell.